Most investors are sitting on the edge right now. Markets are shaking, the news is loud, gold is expensive, and everyone's asking the same question. Should I be buying now, or am I already too late? But here's what almost nobody understands. When panic actually hits, when real fear spreads through the markets, gold doesn't spike. It doesn't soar. In fact, sometimes it crashes right alongside everything else. And that's the moment that destroys the confidence of retail investors. They see gold fall during a crisis and think the whole thesis is broken. But it's not. Because the real gold move doesn't happen during the panic. It happens after. And if you don't understand the mechanism behind that timing, you'll sell at the worst possible moment, right when the real money is stepping in. Today we're breaking down exactly why gold rallies after panic, not during it. And more importantly, what that means for your portfolio right now. Let's start with what's happening in the real world. We're living through a strange period. The economy looks okay on the surface, maybe even strong. Employment numbers are solid. Corporate earnings are okay. But underneath, everything's creaking. Government debt is at levels that would have been unthinkable 20 years ago. The Federal Reserve has swung from hiking rates to cutting them in less than a year. Central banks around the world are quietly buying gold at the fastest pace in decades. Geopolitical tensions are rising, supply chains are fragile, and there's this nagging feeling that something's about to give. So investors are confused. Should they be calm or terrified? Should they load up on stocks or cash? And what about gold? Why is it rising while the economy supposedly remains stable? This is the confusion that creates the trap. Most people think gold is a crisis asset. It's something you buy when disaster strikes, when the bank fails, when the currency collapses, when bombs fall. That's the popular narrative, but that's only the surface explanation. Here's what most people miss. Gold doesn't rally during panic because panic creates a different set of conditions. Panic creates fear. Fear creates liquidation. And liquidation means everything gets sold, including gold. Think about what happens in a real crisis moment. A major bank fails. A war breaks out. A currency implodes. The first thing that happens is margin calls. Investors who borrowed money to buy stocks, bonds, or commodities suddenly need to raise cash fast. What do they sell? Everything, including their gold positions. So paradoxically, during the actual panic moment, gold often falls alongside stocks and bonds. This is the moment that breaks people's faith. They watched gold for years as the ultimate safe haven, and then it crashes when they needed it most. But that's because they're looking at the wrong time frame. The real mechanism is much deeper than a single day or week of selling. Step 1. The panic hits. Fear spreads. Margin calls cascade through the system. Everything sells off, including gold. This can last days or weeks. It's brutal. It's ugly. Most retail investors get shaken out here. Step 2. The fear bottoms out. The initial selling wave exhausts itself because at some point there's no more forced selling left. The banks and funds that needed to raise cash have done it. The system stabilizes slightly. There's a moment of eerie calm. Step 3. Now central banks move. This is the critical moment nobody's watching in real time. When a real crisis hits, not a correction but an actual systemic threat, central banks don't sit idly by. They step in. They print money. They cut rates aggressively. They do whatever it takes to prevent system collapse. And this is where everything changes. Because once a central bank starts the printing press, the value of the currency itself becomes the question. Suddenly, holding cash isn't safety. Holding currency isn't safety. The real safety is holding something that can't be printed, something that can't be devalued by policy, something that has a fixed supply. That's gold. So the timeline goes like this. Panic first, where gold crashes with everything else. Then the policy response, where gold begins to stabilize. Then the realization that the currency is being devalued, where gold starts to climb. And finally, the acceleration phase, where gold becomes the only currency that actually protects your wealth. That final phase is where the real rally happens. History shows this pattern again and again. Look at 2008. Everyone remembers the financial crisis. Bear Stearns collapsed. Lehman failed. Credit markets froze. And yes, gold did fall in the immediate panic, from roughly $1,000 in September down to $700 by October. Brutal for anyone who bought at the top expecting immediate safety. But here's what happened next. The Federal Reserve cut rates to zero. They started quantitative easing. They printed trillions of dollars. And from that point on, gold moved in one direction, up. from $700 in late 2008 all the way to nearly $2,000 by 2011. That's a 185% gain. That's life-changing wealth creation. But it only happened if you survived the panic phase. If you panic sold at 700, you missed the entire move. Or look at the stagflation of the 1970s. Stocks crashed, the economy was broken, unemployment was high, but inflation was even worse. The government kept printing money to try to solve the problem, and it made everything worse. Gold went from $35 per ounce when the dollar was still on the gold standard to over $800 by 1980. That's a 2,200% gain. Generational wealth creation. But people who panicked in 1975 when stocks were collapsing and gold wasn't rallying, yet missed years of gains that came after the initial panic resolved and the currency debasement became undeniable. Or 2020, COVID hit, markets crashed, gold fell briefly. But then the stimulus came. The Federal Reserve cut rates to zero. Congress passed $2 trillion in stimulus, then another $2 trillion, then another $3 trillion. And from March 2020 to August 2020, gold went from 1,680 to 2,070. That's a 23% gain in 5 months while stocks were still recovering. Again, the pattern held. Why? Because in every single case, the panic forced central banks to debase the currency. And gold rallies when currencies are debased. Not during the panic, after it, once the policy response is clear. But that's only the surface explanation of why history matters. The real question is, why is this time different? Because the structural setup today is more dangerous than it's ever been. Government debt is not just high, it's mathematically unsustainable. The United States federal government is running trillion-dollar deficits in a time of relative economic strength. That's insane. In a recession, that number would balloon to 3 or 4 trillion. And there's no political will to cut spending. Both parties are committed to spending. They just fight about what to spend it on. So debt will continue rising. That's a guarantee. Meanwhile, the Federal Reserve's balance sheet is still bloated from post-COVID stimulus. Interest rates are still elevated, which means debt service costs are rising. The interest on the national debt is now approaching $1 trillion a year. That's 10% of all federal revenue, and it's growing every single year. At some point, something has to give. Either rates will be forced to come down, which means the Fed prints money to suppress them, or rates will stay high, which means the government deficit spirals out of control and the currency gets questioned. Either way, the currency loses value. Either way, gold wins. But wait, there's more. Central banks around the world are no longer the marginal sellers of gold. They've become net buyers. Since 2010, central banks have bought nearly 15,000 metric tons of gold. That's an extraordinary shift from the previous decade when they were selling. Why? Because they're preparing. They see the same structural problems. They know that when the next crisis hits, the central bank that owns the most gold will have the most credibility, will be able to stabilize their currency, will be able to demand a higher seat at the global table. So they're buying. Quietly. Consistently. This is smart money moving before the panic. And geopolitical risk is at levels not seen since the Cold War. Ukraine is an active war zone. Taiwan is threatened. The Middle East is unstable. The dollar's hegemony is being challenged by alternative payment systems. The BRICS nations are creating their own currency. India and Russia are trading in gold-backed transactions. The world is fragmenting. And in a fragmented world, gold becomes more important, not less. Because gold doesn't require trust in any single country or currency. Gold is neutral. Gold is portable. Gold can't be sanctioned. So when the next panic hits, and it will hit, the policy response will be even more aggressive than 2008 or 2020. The printing will be even more intense. The currency debasement will be even more obvious. And the rally in gold will likely be even larger. This is the setup we're in right now. So let's walk through what happens next. We're probably in the calm before the storm. The economy still feels okay. Unemployment is still low. Inflation has come down from the peaks of 2022. So most people aren't worried. They're not buying gold. They're not diversifying. They're all in on stocks or bonds. But the structural cracks are widening. Credit card debt is at record levels. Auto loan delinquencies are rising. Commercial real estate is under stress. Bank deposits are still shaky from the regional bank crisis of 2023, and government debt is still growing faster than the economy. At some point in the next 1 to 3 years, something will trigger the next panic. Maybe it's a recession. Maybe it's a geopolitical shock. Maybe it's a sudden realization that the government can't refinance its debt at reasonable rates. Maybe it's a banking crisis when interest rates stay high for too long. Maybe it's something we haven't predicted. The trigger doesn't matter. What matters is the pattern. When it hits, there will be a panic phase. Gold might fall 10 to 20% alongside stocks. Most retail investors will be terrified. They'll sell at a loss. They'll feel stupid for buying gold while the economy was still okay. But that will be the bottom. From that point, the central bank will move. Rates will be cut. Money will be printed. And gold will begin to accelerate. The question for you is simple. Will you panic sell during phase one? Or will you understand the mechanism deeply enough to hold through the fear and buy when everyone else is selling? This is the difference between wealth and poverty in the next 5 years. So what should you be watching? First, watch the Federal Reserve's language. When Jerome Powell starts using the word emergency, you'll know the panic phase is approaching. When he starts talking about unlimited liquidity, you'll know phase 2 has started. That's when the rally begins. Second, watch the dollar index. When the dollar starts weakening significantly, that's the first sign that currency debasement has become obvious. Gold typically begins accelerating 2 to 4 weeks after the dollar starts a clear downtrend. Third, watch central bank gold buying. If central banks accelerate their purchases during a market panic, that's the green light that smart money is all in. That's when retail investors should be too. And fourth, watch inflation expectations. When 5-year inflation expectations start rising again, that's when gold really takes off. Because inflation is currency debasement made visible, and investors flee to gold to protect themselves. These are the signals that will tell you exactly where we are in the cycle. Here's the truth that most people don't want to hear. We're living in a system that was designed to transfer wealth from savers to borrowers. The government is the ultimate borrower. So the government has every incentive to keep rates low and inflation high. That benefits them. It destroys the purchasing power of your cash savings. And it benefits those who own real assets, especially gold. If you hold cash and bonds, you're not being conservative. You're being slowly robbed. The wealth erosion is just slow enough that you don't notice it until it's too late. But if you own gold, you're protected. Not from short-term volatility. Gold can definitely fall during panics. But from long-term currency debasement. That's the real protection. And right now, smart money knows the debasement is coming. Central banks are positioning. Institutional investors are quietly building positions. Geopolitical tensions are rising. The government debt is unsustainable. The currency is under pressure. The panic phase might come tomorrow, or it might come in 2 years, but it's coming. And when it does, the first thing that will happen is fear and selling. Gold will fall with everything else. Retail investors will panic and sell. And then, right after they sell, the real rally will begin. The question is, will you be the one selling at the bottom, or the one buying? The answer to that question will determine whether you're wealthy or poor 5 years from now. If you want more deep market analysis like this, analysis that reveals the patterns that institutions are already pricing in, subscribe and stay close to the channel. Because the window for understanding these mechanisms is closing fast. The panic phase could start any month now, and when it does, you'll wish you had prepared. The time to understand the system is before the panic, not during it.